railway engineering sector chug along or pick up speed? In the railway engineering space, the companies we cover on an aggregate basis had seen their stocks plummet by 21% year on year at the peak of the pandemic in June quarter. Now the situation is much better and companies in our coverage have consistently shown improvement in the subsequent quarters. During the December quarter, the companies delivered close to 17% sequential growth in revenue, while growth on year basis was almost flat. The other notable point is that the companies have posted good improvement in margins. The overall operating margin, which had dipped to 6.4% by the end of June 2020 quarter, has now gradually inched up to 11% by the end of December 2020. This was despite engineering companies, particularly in the construction, power and industrial sector, remaining under stress or the pace of recovery remaining quite low. Order book. Order book is quite robust for the companies we are covering. On an average, they have revenue visibility for the next 3 years, with the highest order book to revenue being for IRCON, amounting to a whopping 32,814 crore rupees, that is 6 times of its revenues. But in general, order inflows or ordering activity was weak in the last quarter. Since the presentation of the budget, process is on to identify new projects, possibly in the first quarter of the fiscal 2022. Meaningful orders are expected to flow once these projects are awarded. The companies are also optimistic about the order pipeline. Earnings outlook and stock ideas. Usually, in the fourth quarter, bulk of the billing is done and revenue is booked. We believe that given the strong order book and improving execution, companies are now able to schedule deliveries. A large part of it, which suffered or got delayed due to COVID-led stress, would be recouped in the March quarter. In the third quarter itself, the operating margins were at the pre-COVID levels at around 11%, which is expected to improve further by about 80 to 100 basis points on an aggregate basis. The cost control measures and benefits of lower commodity prices and operating leverage will be visible, reflecting in their profitability. Earnings growth is expected to be much better in the March quarter and the next fiscal. But still, in the current fiscal, the impact of first 2 quarters due to COVID-19-led slowdown would be visible. It's in the next year these companies hope to report strong growth. So which are the stocks to pick up? Even though share prices have seen some uptick in last 1 year, we recommend companies which are having good revenue visibility, strong balance sheet and trading at reasonable valuations. We find good value in stocks like Urcon and RITES. RITES is trading at about 9 times its fiscal 2022 estimated earnings and offers a good 6% dividend yield. Urcon offers similar opportunity, trading at 7 times its fiscal 2022 estimated earnings and a dividend yield of close to 7%.